Welcome, trusted advisors. This is the podcast where we explore what it really takes to build, grow and sustain a thriving financial planning business. Every fortnight, you'll hear candid conversations with the leaders, innovators and trailblazers of our profession. People who have navigated the challenges, embraced the opportunities and are willing to share what they've learned along the way. If you're curious, ambitious and committed to raising the bar in advice, you're in the right place. Today's guest is Drew Burden, co-founder and CEO of MBS Insurance, a business turning 20 this year that has grown from $8 million in premium and 1,500 clients to $250 million in premium and 25,000 clients over the last decade. Drew puts that growth down to three deliberate choices: hiring people who are better than the role demands, building a genuine flywheel effect, and the discipline of sitting down every quarter to work out what the business actually needs to focus on right now. We also spend time on the technology piece, which is a real differentiator for MBS. When the market wasn't building the tools they needed, they built their own. What started as a Salesforce action plan for onboarding new staff has evolved into a platform that drives automated policy feeds, SOA generation and meaningful data on where advisor time is actually being spent. Drew talks about the moment they repurposed 9 people who had been doing data entry full-time and what that unlocked. We also cover their JV and minority investment model and the hard lessons picked up along the way. Hope you enjoyed this conversation. Welcome, Drew Burden, to the Trusted Advisor podcast.
Thank you, Rob.
Great to have you on, Drew. We have known each other, I'm going to say probably 6 years or so. We first met when we realised that this insurance caper was a pretty challenging thing to do part-time when you're in the wealth space that we're in. And we went looking for someone to join us initially. We thought we'll actually find someone who can come in and become our specialist in-house. But then we met your partner in the Perth office here, Jade Burford, who, congratulations, Jade, just picked up the Risk Advisor of the Year in the Women in Wealth Awards by Financial Newswire.
Yeah, she's phenomenal.
No surprise, great human and a great insurance specialist. And it's been a wonderful partnership we've had with you since 2021. It's a joint venture that's been profoundly successful for both of us. So it's great to have you on. I had Jade on at episode 6 and we shared some personal anecdotes there. But you've been at the helm of something which has been growing in such an impressive fashion. It's such a good story. I couldn't help but want to have this chat and just to share a bit about what MBS has been up to and the fact that you are focused in on the one core area of insurance specialist advice, and consequently, you're doing it exceptionally well. MBS turns 20 this year. In fact, you have your 20-year celebration tonight. I would love to have been there, and thank you for the invite. I can't make it, but I'm sure it's going to be an amazing event. You know, a lot of firms in the market have exited insurance entirely because it's become really difficult. You've not only stayed, you've scaled dramatically. And for listeners who might not yet know MBS, tell us about the business as it stands today. Tell us, what's the state of play for MBS right now?
Yeah, thank you. And thank you very much for having me on. We haven't deviated. We sort of viewed that since inception in 2006 that it was a specialist discipline and that would become increasingly. So I think we've had some, regulatory intervention which on the surface looked challenging but actually helped shape MBS. And we'll probably get into a bit of that later. But yeah, today I sort of think about MBS in blocks of time on occasion. So for the first 10 years, that really was a foundational period. We sort of got to 1,500 clients, $8 million in premium. And it was a really pivotal time for anyone who knows life insurance around the lift changes that were brought in. But going from 8 million in premium in 2016, today we sit at 250 million.
Wow.
We went from 1,500 clients to 25,000 over that next 10-year period. We've spoken about it previously. I think when you look at the stats, it feels significant, but, we went on a deliberate path to scale. It sort of felt pretty fine and manageable along the way, and it probably gives us the confidence of what the next 10 years looks like for us as well.
Yeah, tell us about the scope of the business now in terms of across the country. How many offices? Where are you located in Australia?
Yeah, so we were back in 16, we were just in Sydney and there was 7 of us. Now we're in Sydney, Melbourne, Brisbane, Perth, We have a presence in Canberra and Hobart, but there's about 100 in the team.
So, and 100 in your team, and that growth that you described in terms of the premium and number of clients you now serve is quite extraordinary. Obviously, it wouldn't have been linear and it wasn't, I'm sure, smooth the whole way. But as you said, it wasn't insurmountable. Never felt like it was like speed wobbles off the rails. It was just incrementally moving forward, making change to improve all the time. And next minute you turn around 20 years later and you look back and go like, wow, we've kind of come a long way in that time.
Yeah, and I think the real pinch me moments is when you have the caliber of people either joining your team or within inside the shareholder group or exec team and what have you. When we made that deliberate decision to scale, there's probably three key components to that. Really fortunate timing. We received some advice from a fellow who was quite senior in Yum Foods in the US. And his view was that if you wanted to truly scale, and you had certain key roles, let's imagine that role demanded someone to be paid $150,000. He said, go and find someone worth 200 or 250 and pay them that, because they will cover the spread absolutely and they'll help the business grow and they'll sort of drive the business rather than solely rely on the management team or the existing shareholders to drive it alone. The second thing was we sought to create a flywheel effect, and that's something that is no doubt been spoken about or read about by many. I think we truly were able to achieve that. And then the third thing was a recognition that we couldn't do everything at once. So every quarter we would sit down at a board level and say, what are we going to focus on over the next quarter? Is it distribution? Is it our advisor cohort, onboarding, offboarding, capacity, etc.? We'll do the same for the ops team, the finance, technology, governance. We sort of had a recognition that if we were going to get to where we wanted to go to, like little bites at a time, we had to work on things that were really critical at that time and what would benefit us in that next period.
Yeah, there's three great insights there, and I think we should just spend a minute going back over them. You said Yum Foods. Now, just for everyone who doesn't know Yum Foods, they are the parent company of a number of chain businesses in the fast food space.
Yeah, the KFC, Pizza Hut, all the healthy ones. Yeah, I mean, that was an individual and a business. And I think the brands, they've got many more than that. But their whole ammo was scale. Like, how do you actually get something that on the surface might look reasonably simple or what have you? And how do you actually scale that across jurisdictions? I'm not sure that the alignment between MBS and Yum expands further than that, but...
No, but the principle was sound in that you find a way to scale, but the point being that you find people that are worth every bit and more of what you're paying them, and you just pay them that money because they'll actually drive the business without you having to kind of like hold their hand and push them along, because they themselves are highly capable and can drive growth and change that you don't need to necessarily have your hands all over.
Yeah, and Rob, it's getting people who have a skill set and experience that you don't have. In 2017, Caroline Clark joined us. She was running a business with 60 staff. We had 7 or 8. She had multiple service lines. We had one. She was really going to help us systematize, and she did. A couple of years later, we went from having an internal accountant to bringing on a CFO, and that being Grant McLennan. We sort of met the market, was probably ahead of our time, but he proved up that absolutely right away. I sort of view the right CFO is a great strategic mind and actually is more of a revenue producer than a cost counter.
Yeah, I've had a lot to do with Grant along the way as we've done some merger activity together where you've taken the insurance component of businesses we've folded into HBH, which has been a great arrangement that's worked well for both of us. You also mentioned the flywheel effect. That's the Jim Collins first talked about that in his Good to Great book, which is obviously working well for you. And I thought I'd just make that reference for those that hadn't heard that before. If they haven't been around and reading like we have, because that's kind of pretty commonly well understood principle, and we've got our own version of that. And the final one you spoke about, just to jump into that quarterly rocks thing you spoke of, that's effectively the Gino Wickman traction sort of principle of quarterly rocks. I think it was first put together by, I think it was Stephen Covey initially that put the quarterly rocks together, that sort of concept. And it was picked up by EOS. It was picked up also by Vern Harnish in his book, Scaling Up. So that quarterly principle, that discipline of sitting down every quarter and going, okay, this quarter, what are we going to work on? It reminded me of the principle Jim Collins talks about as well, the 20-mile march. It's just that principle of just being consistent and staying true to your plans every quarter and not trying to do too much all at once, but just being focused every 90 days. What are you going to work on?
Yeah, and some of it's a gut feel and some of it's more analytical than that. But if you're forcing yourself to have a look at those things, if you're forcing yourself to work on the business rather than just be in it, and naturally we're pretty competitive. We're driven by opportunity. Chris Mason and I, who have been around sort of the longest period, have always been very aligned, but we are competitive and we are, looking at what exists in the market and where the opportunities are for sure.
I just want to touch on the sort of competitive edge that you've actually been able to establish now in the space you're in. It's been a deliberate decision that you've taken to build your own technology stack rather than waiting for the market to catch up to where you want it to be. What was the moment or problem that made you feel like the only option was to really build your own tech in-house?
So this is all stemming from 2016, really. And that was also going back to this genuine attempt to create a flywheel effect. We didn't observe any technology in the market that was great for risk specialists. Whilst we were clear that we weren't tech people, we thought that we would stay inside the Microsoft and Salesforce ecosystems because we sort of felt from a cyber perspective that was a sensible approach. But what we did with Salesforce, the first part of the flywheel was actually increasing the capacity of the team. So we looked at it in layers. We'd first increase the capacity of the team working in bottom-up approach, would then acquire efficiently, would seek better arrangements with insurers, would onboard talent, would progress people through the PY, and would constantly try and increase the volume of premium that we wrote, but also the clients that we managed and the B2B relationships that we enjoyed. But the technology piece, because we didn't have any offerings in the market that we thought were amenable to our growth ambition, we started with Salesforce. And what we did is, if we knew we were going to onboard new people, like how are we going to train and onboard those team members? So in Salesforce, we built action plans. Effectively, if you started at MBS, Rob, the task in front of you would be presented and then you just follow the bouncing ball.
Yeah.
And that made it easy for us to train. That made it easy to bring people up to speed quickly. But what it truly did is it allowed us to analyze where people spent their time. And so ever since then, we haven't changed this, but for the last decade, we just watch where, what processes take the most time of the team or what processes are better done by a person or better done by some level of automation. And then, the system will update and someone will see that now they don't do steps 1 through to 10, they do steps 1 and 4 and 5 and 7 and 9. So it's not been about going and canvassing the team as to what changes would you like to see in the system. It's actually just observing where the time is spent and what that cost is to the business and whether that's an effective use of time and resources.
Yeah. One of the common themes that's emerged through the conversations I've had on this podcast is that people say, build great processes and then put the technology there to support that process, because people think technology will solve their problems. But if they haven't got a good process, as you've just described, technology won't be the solution. In fact, I was listening to a podcast recently, someone talking about the top 3 things that actually have driven the most positive change in businesses, and it actually was in financial planning space. They talked about team structure being number 1. This has come out of the dimensional benchmarking study as well. Team structure being the first one, second one being processes. And everyone who's sort of heard that before, it's worth repeating. Get a process that you can follow and nail down. And as you say, follow the bouncing ball for a new staff member joining. And the third one is technology then to amplify that process and make as much as what's possible to be automated run without a human having to intervene. Walk me through that part of it, the automation of your policy data feeds, because people kind of love this idea of having information at their fingertips. And I didn't think risk insurance data feeds was kind of really well done. In fact, we were with Xplan, still have Xplan in our tech stack, and risk policy data feeds were not a great feature of how we would get information on the risk policies we had back in the day before we joined with you guys. What changed there for you operationally and your ability to then scale the business when you built more automation around your data and how you could manage information?
Yeah, so people were just spending a lot of time doing menial tasks that really didn't add any value. Like, we would get very frequent requests for a summary of a client's cover, be it from their accountant or wealth advisor or from the client itself. And our team never really trusted what was in the system. So then they'd go away and jump on the advisor portal and look at that and update our sales force and then generate a report. And we were spending a reasonably offensive amount of time generating summary schedules. So that was an obvious problem to solve, that when we would get larger, giving partners like in your firm visibility over live data, it's something that we would expect. But that is a huge time unlock. And actually, the flow-on effect of having accurate information and accurate data, it is quite significant. The first time that we were able to achieve sort of accurate live information, we were able to repurpose 9 people who were doing it really on a full-time basis. And it was such a menial, boring task for those capable people to be doing. And we needed them to be doing it at the time, absolutely. You can't, acquire and have organic growth at the level that we did in partnerships without actually ensuring that you have some level of integrity of your data. But yeah, that's been a huge time unlock for us. And we thought this market opportunity that existed would probably have reasonably expired by now. So we're running pretty hard in those early years. We sort of thought that by 2023, there'd be some recalibration. There hasn't been yet, certainly across all aspects of life insurance. So we're now working with some of our competitors and investing in those businesses and giving them the capacity or technology and processes that we enjoy, because there's a big market opportunity and we're not going to do it alone. So it's been very beneficial and probably akin to what you enjoy in the wealth side, to be fair.
Let's just recap some of that growth, Drew. In 2023, you had 24 authorised representatives, and now at 41 ARs, or at least last time we chatted a couple of weeks ago, you're at 41, you may be more now, and you're managing at 25,000 clients you mentioned. What's been driving the growth rate? Because the business has changed, obviously dealt with some of the recalibration, or probably hasn't come through yet in the risk space, but what's driving the growth in your business, the rate that it's coming through?
The capacity of the team. So just that persistent analysis of where people are spending their time. So we've sort of always maintained that, clients need personalized, tailored advice. And we've had an internal quality assurance team that audits every client, audits every file before advice goes out. We've always viewed that advisors are better off having the conversation and giving the advice rather than the documentation of the advice. And so we've tried to think about how we can allow our advisors to get in front of more clients, how we can allow them to provide that advice that is tailored and then support them along the way. So a few years ago, 2023, you quote that year, we would have hoped and expected that our average clients engaged in completed policies would be about 120 per advisor. Now we're probably looking at 160. Some in our team, I've looked last night, are sort of touching 190 lives that they've provided full advice and completed portfolios for this year. But that's been the biggest differential, that, if we went back to 2016 and some other risk businesses that we look at, some are looking at around 70 or 80. I think that we're probably doing a very similar thing to them. It's just our advisors are being more deliberately supported.
Through that tech investment you've made, just the technology that you've put in place to make everyone's life a little easier so they can be in front of clients more, be more effective. And so it's kind of like you're at the front edge of what everyone's dreaming about, really, is to actually get to the point where advisors are better supported with technology so they can be more in front of clients. And you've done that deliberately from the word go. Obviously, you set out and we've got access to the Salesforce platform you use. We were one of those firms that was asking for those policy summaries for our clients, and we were no doubt annoying you for those when our clients were being seen by our wealth advisors.
Yeah. So one of the pain points that has been resolved is around statements of advice, and then I'll talk about probably the next pain point that we'll seek to solve, which is applications for insurance. But I think that probably just gives you an idea of what the focus and intent is. So for us, an SOA is really the consequence of the inputs and what is required to be disclosed and analysed. So, it's getting the client health information, it's completing the fact find, the needs and objectives, building a strategy, comparing existing policies if they have that, and then providing a recommendation. And so the system really should be generating an SOA from that point, as opposed to us historically going into an old Word template or whatever we may have done and meshing in all of the required disclosures and information for the client to understand. So we've got that to a point now where An advisor should be ready to be able to meet with a client and have advice presented within 4 or 5 days. The reason it's taking that long is because our internal quality assurance team needs to audit the file and needs to audit the advice, because people can make mistakes or what have you. And it's just better having a second set of eyes run over that. They're being supported as well by some technology, but we do have that and want that manual engagement where someone is looking at one of our advisors' advice and saying, yeah, have they properly and appropriately explained what the conclusions are and how have they come to that, etc. But the next one that's a little bit frustrating is advisors completing applications. They're just rekeying information they've already got. It's just such a waste of time. I had one of our advisors the other day. He said, I'm going to work from home tomorrow. I've got 4 or 5 applications to submit. And he didn't need to say that for us to know that was a problem. But
Yeah.
it just seems such an ineffective use of any of our advisors' times. You probably expose yourself and the client to someone keying in something that's not correct.
Potentially transferring information that's not accurate. So yeah, no, it makes sense. Well, you've ticked off the database management piece and repurposed 9 people. So that was a big milestone moment for you, and to redeploy people for more productive tasks that are less menial and more interesting for them as well, I'm sure. The advice production.
To give Chris Mason credit, he's really been on since day one about career progression. So, it's good for the business to progress, but it's important for the people, within the team to have the opportunity to progress their career as well. And doing the same old task every day, year in, year out, is not the most exciting proposition.
Absolutely. I think there'd be power planners out there that would be thinking they can't wait to get to that point as well. Certainly writing plans all day, every day for years on end is not really an aspiration I'm sure many people have, but it's a great stepping stone type role. But if we can actually go where you've gone in the wealth space as well, to actually get SOAs generated off the back of the rich context conversation that the clients are having with their advisor, that does seem like the next logical step. So you've done that piece of it as well, and now the applications is on your radar to try and get that automated so that the data that's already been captured is being more seamlessly transferred through to the application process. You shared a data set with me some months ago that showed MBS writing significantly more premium per advisor than virtually anyone else in the market. I actually looked at it. It was like everyone else was on Earth and you guys were on the moon in terms of the volume of premium per advisor that you guys write relative to the market generally. What does that gap tell you about your business relative to the market?
So if you write insurance, for us, there was 15 consecutive points of negative regulatory intervention, right? Where cost of advice, education, commissions levels, etc. A lot of people stopped. Institutions, banks, they sort of got out of it. So the motivation for someone to come in from a tech perspective and monetize the diminishing opportunities just wasn't there. I thought we would have recalibrated as a market by now. We haven't. There's still so many Australians that need to get retail advice. We would expect that the market should be at least 2 times the size that it is today. If you have a look at how society has grown from a debt to income ratio, people are getting married later, having children later, working longer, living longer. So the need for advice has become greater. But there's not great technology to support advisors in the market in our space. And insurance has become increasingly complex. It's only 4 products. It shouldn't be complicated, but seemingly is. So yeah, we work closely with insurers. We distribute their products, so we consider them partners. We make sure we support our advisors with distribution and, relationships with firms such as HBH. But there is a big gap on the market.
The reality is, you've got technology that underpins the advice process. So I guess you are able to generate more throughput, per advisor, as well as the fact that you've got such volume through the insurers that you use, there's better rates to be obtained. And would it be fair to say that those insurers treat your applications with the greases on the wheels a bit more because they're so used to seeing volume from you guys? Do you actually feel that you're getting some arrangements with your insurers that is kind of preferred because of the volume you're putting through?
Yes. We've also been very deliberate and proactive in our discussions with them. We were really clear that this was the journey that we were going to go on. I would say that momentum is super powerful. So if you refer a client to Jade and Jade does a great review and portfolio strategy for that client, and maybe it's recommending they retain, maybe it's recommending they reduce, whatever it may be. But if it's done effectively, efficiently, professionally, you're more inclined to refer another client.
Of course.
And that momentum is really significant for us. We work with the insurers as well and understand their pain points. So some insurers talk about point of sale acceptance rates as being something that during their underwriting process they analyze. So they've got costs, obviously.
Yeah.
So they understand the acquisition costs of putting a client on the books. So we've tried to work with them and feed them information to actually improve their efficiency and to have them absolutely deliberately wanting to work with MBS or MBS clients as a priority. And then that evolved to us getting like true dedicated underwriters and premium service team and BDMs and what have you, and having those relationships whereby I know that today we have an underwriter from one of the insurers in our office. That's just really helpful resource. So we're in a fortunate period where we are distributing the most retail advice in the country. And so we're constantly meeting with these insurers on a quarterly basis. Chris McKenzie, our head of advice, has a great relationship with all of the key people at each of the insurers. And we are working together to solve a common need, and we've got mutual clients. So to be honest, I'd expect our advisors and our clients are looked after.
Yeah. And hence the premium per advisor is obviously higher than everyone in the market based on that data set that I've seen. And just worth spending a second on the fact that you've actually treated the insurers like partners, not as providers. They're actually a partner in your business. And so you thought about how do we make their process easier so that it helps them, so that we can be doing things with them in a way that's more productive for both of us. And so that's a mindset not everyone brings to the table, Drew, to be honest, but you've actually thought about the whole value chain. How do we make everyone's life easier so that we actually can be more productive together?
Yeah, I mean, there's 4 critical parties in our value chain. There's HBH, there's our partner firms and the advisors there. There's our advisors, there's the insurers, and then obviously the client. Now, we're all working towards a common goal. And so we, of course, should be working with them, not against them. And it goes well beyond, like, our advisor might not always agree with an underwriting decision, but it's not acceptable for them to give them a piece of their mind. But then we've got to be smarter about that as a business. So one of the challenges that we've seen is this premium instability. Like insurers, stock growth for insurers, absolutely not good for clients. It's not great for us. How can we work with the insurers to solve that? How can we understand some of the challenges the insurers are having and actually work together to solve that more effectively and more efficiently? So we're distributors of the products, delivered by these product manufacturers. And it's not just about new business, it's about ongoing. It's about claims as well. Like Lauren, I know I was speaking to Lauren the other day, and we have had more claims this year than one of the insurers, which is, it's not great because there's obviously people who are unwell or injured or worse. But it's important to have those relationships and for everyone in our business to understand that we are partners with the insurers.
Yeah. I've personally experienced that claims process, and Lauren is a superstar. I'm sure she's got great people working with her team as well in the claims department. So it's a great, efficient part of your business, which is the critical part, isn't it? It's good to get insurance cover in place efficiently, but when the time comes, if you're making a claim, you want it to be a painless process, and certainly it was that when I went through it. Let's go back to the 40 to 50 firms you've now got in some form of joint venture arrangement. I just had Rebecca Ty from Game Plan Wealth Advisors on the last episode, and Rebecca shared with me, I didn't realise she was working with you guys as well, doing insurance, and she works with a young accumulated client, but has said, I think it's a specialist area. And yes, whilst we work with young clients and they have insurance needs, we just don't want to be trying to do something we're not great at. So we work with the MBS team. You've recently also started doing something which I know that people have heard about from other parts of the investment market or actually the wealth space, but taking minority positions in selected risk practices. What's the distinction between the two models? That the JV is one version. What's the logic behind the minority investment approach specifically?
So at a macro level, the market opportunity is incredibly large. We've got, as you mentioned, 41 authorised representatives. We've got 10 going through the PY. Hopefully they're all successful over time, but it will take time. There's a lot of quality risk writers. I know there aren't an abundance, but there are quality risk writers in the country. And we sort of thought about it and had conversations around, well, if we'd had the technology, if we'd had the insurer arrangements, if we'd had the capital available to us back in 2016, would have that been a path that we would have chosen to do rather than build out ourselves? And, the answer was absolutely. So to date, we've got PRP in Brisbane, great team, and the business been around for 14 years. Similarly, Orbital, Nick and Rachel Fanto and their team, they run quality businesses. They're quality people. And so we had conversations with them around, well, actually, how can we help you to grow? Both businesses had an embedded network. Both businesses had ambitions to continue to drive distribution, to build their team out. It's all of the other stuff that we've already done that actually we could deliver them. And so we sort of said to them, if you approach this in the right way, we would see that you would go from here to here. We charge them a cost recovery, but we just don't want to do that and not be aligned. Alignment's really important. So we want to share it with them. So, our model is to buy 25 or 30%. We would buy more, absolutely. We want to invest alongside them. So, at a minimum, we'd look to buy 25 or 30% and give the existing shareholders that remain in the business the greatest incentive and motivation to keep pushing that business forward. But there's such a significant market opportunity out there and there's such a significant need. Why should we just look at them as competitors rather than look at the opportunity larger together?
Yeah, well, as you say, you'd built the technology that underpins your business that is transferable. You've had the preferred insurer rates and terms that you've actually been able to achieve through volume. So taking a minority position in businesses that are forward-thinking, where they still own and operate their business, but have now a partner that brings a lot of capability to the table that helps them really leverage what you've built and grow their business, makes a ton of sense for them and for you.
It helps them and it helps us, absolutely. Like if now we've got, instead of 41 ARs, we've got 51 ARs, we've got more revenue producers to just, to apportion the expenses or the reinvestment that we might make. We're now distributing greater levels of insurance and managing greater volumes of existing policies, and we can build out our claims team even further. So yeah, it's just helpful, and they've got the motivation and the financial incentive to keep going forward. And certainly with both of those businesses, their identity remains PRP and Orbital, and they've got a lot left to achieve. We'll just support them on that. We didn't go in there and say, okay, well, we expect that you'll get from A to B. Like, it's their business, it's their journey. We're just there to support them, and we'll both benefit from that.
Yeah, not interfering, just helping to underpin their business growth objectives with what you're bringing to the table. So yeah, it makes a ton of sense. What does that first 90 days look like when you bring a minority partner into the fold? What do you do for them? What does it look like for them and for you?
Well, firstly, I wonder if you have had the same, you've grown, your business 24 years old, whether you've had the same experience. When we brought on an experienced advisor into MBS, in the earlier days, we'd sort of softly let them come into the building and, observe everything and let them sort of settle in a little bit. What we've realized is actually they've got expertise and experience, and that's why they're on board. But if we actually onboard them quite intensively, the more that we do that, the better the outcomes are going to be, and they're going to come a lot quicker. So for a team, the first 90 days is like that as well. Like there's two elements to it. Like nothing is going to change in terms of you're still going to work in the same office with the same clients, with the same colleagues under the same brand, but everything is going to change. Like you are now going to be using Salesforce. We actually will rebuild their entire database within a week because of our data feed. So we don't really worry about importing their historical information. They'll retain licenses, perhaps with Xplan or whomever, as it might relate to file notes and what have you. But we will stand up their database really quickly. And when I've talked about back in 2016, all of the process and action plans, like it's the same today. So I'm sure it's in the shorter term, there's a fair bit to digest for the team, but they should be able to get on top of it and going out the other side within 90 days, absolutely.
So you really go intensive early on, and I think you said to me once that you spend 2 or 3 days in their office with a group of your people that go up there and literally run them through the process, chapter and verse, intensive training workshop for the first few days, and then as you say, you stand up their database from your own data source or from the insurers directly rather than trying to rebuild their data from doing a data transfer. So that makes a ton of sense.
Yeah. So we break their business into three components, one being sort of the client services, another being the paraplanning, another being the advisors, and separate people from our business will go and train. So they'll spend 3 days. The client services will be with our dedicated person who looks after client services. But yes, we have benefited, and I'd encourage anyone else, onboarding talent or teams to do it reasonably intensively rather than let people sort of settle in, and because the benefits seem to compound on the other side.
Yeah, it makes sense. There's good lessons and learning in there from your experience. So I appreciate you sharing it. I know that Merchant Investment Management have become a key partner of yours. A couple of years back, they took a minority position in your business, much the same way you're doing now with Orbital and PRP. What has made that feel like a partnership for you rather than just a capital transaction at the time?
Yeah, so we weren't looking for capital at the time. We were being well supported by Macquarie, but they came along and they offered the opportunity to buy primary. So on balance sheet, rather than us look to take some money off the table, we still felt like we've got a lot left in us. So they made an investment which allowed us then to probably reset from a debt perspective and go again, to be fair. So it was quite encouraging when someone else came in and said, hey, we want to buy 20% of MBS, but also we're up for it. Like, it sort of recharged us as well. I don't think we needed it, but when your debt is reasonably significant and goes back to zero and you get the opportunity to go again, well, as I said, we're a reasonably competitive firm. And, there's three people here in Australia, Jamie Melville and Beck Wells and Ellie Glotzer, who are supporting us as well and dealing mainly in the wealth ecosystem, where they're speaking to new firms or existing firms saying, hey, you should be dealing with MBS. So it's more than money.
Jamie and Ellie from Merchant were in my office about a month ago. Yeah, so they're out and about. So yes, they'll be representing obviously merchants' interests, but also, as you say, working collaboratively with businesses that are maybe looking for a risk insurance solution, because you say it's become a pretty complex space to be in, and you guys have obviously pretty well got it nailed down. You said that money from Merchant went onto your balance sheet, paid off debt. You did 21 transactions last year alone. When you're looking at an acquisition now versus 5 years ago, what's changed about what you're looking for?
When we're looking at transactions, we've always been of the view that we would want to work with partners who have had a history doing life insurance, so that there is existing clients. We want to be aligned with the people. I think we've realized that to be in business or have relationships with the wrong people, it just causes more pain than benefits, irrespective of any money. And then the last one is we want those firms to be growing so that our advisors and our teams grow with them. That's more exciting for us and for them. What has been really interesting is really since the Royal Commission, a lot of wealth advisors haven't been writing a lot of business. It seems that a lot of those portfolios that we're looking at every year are just 1 year older on average than they were the prior year. And that's a bit of a problem. It's a huge opportunity for our advisors to provide those clients with a recalibration, not just about rewriting, but we might have some discounts that we might be able to embed into existing policies, like some retention discounts. But the biggest observation is there's a lot of clients who haven't received advice in a long time. I won't name them, but one of the insurers mentioned to us, they're enormous. 70% of their clients are effectively orphaned.
Wow.
Which means they do have an advisor named next to their policy, likely or often, but nothing has been happening or communicated via the advisor with those insurers. So that's a problem.
It is.
It's also an opportunity for us, to be fair, as well.
No question. I mean, people who are doing wealth predominantly and doing a bit of risk on the side, or have historically done a bit of risk on the side because it's been a core part of the offer in their view, but have kind of become a bit reluctant to do it because it's hard and they're not specialists at it. And, it seems obvious to me talking to you, and obviously because we've got firsthand experience, that the clients are better off. You can actually get leverage off your existing relationships with those clients on the insurance side, but you can actually start to really think about providing a much better service to those clients and grow again in that space with a partner that can specialize in it. So, our experience is true of what you said there around just the clients get a better experience. There might be, as you say, discounts available. There would be things we looked at that maybe you didn't think we could change, but exclusions being sort of removed, loadings being removed. So things that we experienced when we first moved across to work with you guys, that became obvious that these guys really know what they're doing. They don't think about anything else. So our clients got immediately a much better experience from a specialist firm. So it's a great credit to you.
Thank you.
You've got 30 people now on your equity ownership cap table. For a firm that was a partnership of trusts not long ago, that's a meaningful cultural shift. What made equity access feel like, you said there earlier that Chris was very much about career trajectory and growth for people. What made equity access feel like the right mechanism for you for retention and alignment? And how do you manage the complexity of that many shareholders?
So both Chris and I actually used to refer to Chris at the very start, and I was in finance. We both worked at businesses that we really liked and enjoyed, but we didn't feel, independent of each other, we didn't feel like there was a pathway to equity. And we have benefited from many of our existing shareholders that have come on board to us because we've demonstrated a really clear pathway to equity. What that means, it's not just for advisors. We do have some non-advisor shareholders as well who contribute greatly to the team. But we always felt like if it was important to us, why would we not think it's important to other people? So from a talent retention, a talent acquisition, that would be a key ingredient. But probably more so for alignment, having people, it creates alignment, it creates motivation, it creates great momentum. Like, it's just been really positive. What we have had to do as we've grown more, so this is, I suppose, around the question around complexity, like how do we manage 30 owners? We've had to be really deliberate, and, we've maybe stumbled at times, but around that people got to play their roles. So the business will benefit from people knowing their role and playing their role. And we have 5 on our exec team. We also have a couple of externals. We have a chairman with great experience as an insurance lawyer and has run AFSLs and super funds and what have you. And we have a couple of other advisory people that are really outside from the industry. So we are trusted by the 25 odd internal shareholders that aren't on our exec team, that we are going to be running the business in the right way. And we do catch up. The shareholders will catch up 3 times a year, twice in person and 1 time virtually. But everyone's got access to information at all times. So everyone's got dashboards on Salesforce, and they will understand where the business is going and where it's at. Everyone knows what the requirements are to be able to be offered the opportunity to buy in. That comes at 1 July every year, and everyone understands the formula, which is a multiple of EBIT, of what the price will be. So yeah, we've enjoyed that.
Yeah, and provide people with the clarity and transparency of what it takes to get there and what it looks like once they are there in terms of the dashboards you've got. It's a powerful mechanism to, as you say, get that alignment you speak of. And I know we share this philosophy. We've approached it very similarly about retention and alignment, and you just get that level of engagement that you wouldn't otherwise see. Not to say people would never be wanting to give their best at their role, but it just levels it up in a way that's hard to define until you see people really think like an owner, because they are. So a great credit to you to have done that and to see just what it's done for your business in terms of leveling those people up into that level of ownership and engagement. So as I say, I share that philosophy and we've gone down the same path. But let's talk a bit more about the future. I've got 2 more questions for you because I know you're on the clock today. You've begun to think about how MBS might be able to serve the 5,000 or so advisors nationally who just write a handful of risk cases each year, like we just talked about a moment ago. What would that model look like? And is that a near-term priority for you or more of a future ambition?
This is something we would want to be significantly progressed this time next year.
Okay.
What is often reported is that you have 120 risk specialists or risk advisors that write $45 million in retail advice. The next $45 million is written by 350 advisors, and that's considered the key or the primary core. You then have 5,000 advisors that are writing apparently 240, 250 million in premium a year. So let's say $50,000 on average per annum. It's that cohort that obviously don't mind doing it, would see a need. They're probably wealth advisors with maybe 150 family groups, and they have a core that they want to do intergenerational advice, or the younger accumulators. So we can't scale from 41 ARs to 300 quickly and not in the right way. And there is a proper program of PY. So in the same way that we thought about minorities, how can we actually help those 5,000 advisors that write on occasion and manage it? So this would be the creation of a platform like what you see in wealth. We want to have a crack at, whilst we've always viewed ourselves as specialists and staying in our lane, we don't see this as being a great deviation from that. We already know the front end piece. We know how to generate advice documents. We know how to manage existing portfolios. Can we help with some of those writers that write on occasion? Maybe instead of doing 50,000, maybe they do 80,000. Maybe we should make it easier for them to engage with those clients they really haven't engaged with since the Royal Commission, as an example. The efficiencies that I spoke about, imagine if wealth advisors who are still happy to do it but never had to load another application. I mean, there's things that we can do to support that group. And I know insurers that we speak to, they're very motivated about solving that. It's not going to be easy, but we're going to have a crack.
Yeah, that'd be impressive, because I know a risk platform has been talked about for many years, but actually, given you are effectively doing it now because you've got the technology build with those insurers, it seems like a logical step for you, and I wish you well on that, because it certainly would unlock the opportunity for those advisors to actually run a more effective part of their business if they don't want to outsource it or joint venture it with you, but actually just stay doing it, but do it in a much more productive way than they can do it now with the technology and the systems you've built. So one final question. I thought this was a really good story to share. You made a comment about the first client acquisition you ever made.
Oh.
You mentioned the lawyer's letter you received 2 days later, the money being gone, and then going out and buying the next one. 20 years on, what do you think is the biggest lesson you've learned along the way?
Yeah, so that book that we acquired, that's a brutal memory, where the lawyer kindly let us know that the book that we acquired from the individual we acquired it from didn't actually own the book. What have we learned moving on? I think what we have learned, and I would say this to anyone who's doing any acquisitions, if you buy something that isn't great, doesn't matter the price that you pay for it. Find a good asset, pay a fair price, and the distractions won't be there to the same degree that they will be there. If you buy something that, I won't say the word, but it's no good, it doesn't matter. You could get it for free. It's not worth it.
Yeah. So if it's cheap, there might be a good reason. Maybe look for something that's quality that you can own, pay fair price for it, and let it continue to grow on the back of the quality it already has. So I think the lesson that I took away when you shared that story with me, and I'll let you elaborate further if you will, but it was just the fact that you went like, well, that didn't work out, but okay, well, where do we go next? We learned from that, we move on. We don't commiserate forever. We just say, okay, that didn't work out. We just need to look a bit harder next time and learn from it.
Yeah, and we're better at acquisitions now than what we were at the start, but we weren't afraid to try. Nothing ventured, nothing gained. Like, a lot of people speak about the desire to do acquisitions. Nothing's perfect. Hopefully you can buy an asset that you can improve. Hopefully you're buying an asset that is beneficial for the team. Hopefully you're buying an asset that maybe comes with talent as well. I think that if you want to do it, just have a go. And sometimes learning a lesson is hard at the time, but you'll be better for it as long as you don't get off your skis.
Yeah, absolutely. So thanks again for being such a great partner for us, working in a joint venture arrangement. It's been a wonderful relationship since the day we joined, and I think it's just because we're values aligned. Everything you've talked about, ownership and alignment and working with the right people, and we felt the same way, and it's been terrific to work with Jade and Shane here and Serena in the Perth office. Just quality people doing great work that actually makes our clients' lives better and makes our lives better. And I wish you a wonderful evening for your 20-year celebration tonight. And you've obviously got some great history to reflect upon with the whole team that's been a part of that. And the aspirations you've outlined just now, I look forward to watching with interest as to how those things go, because you are competitive, as you say, and you don't take no for an answer easily. So I'm sure you will achieve great things still to come. So Drew Burden, thank you again for joining me today on the Trusted Advisor podcast.
Thank you, Rob. Absolute pleasure. Really appreciate it, mate. Thank you.
Thanks for tuning into the Trusted Advisor. I hope today's conversation brought you new insights and inspiration for growing your business. If you enjoyed this episode, please subscribe on your favourite podcast platform. leave a review and share it with others in the industry. And don't forget to connect with us on LinkedIn for updates on future episodes. Until next time, keep building trust, embracing innovation and driving success in your practice.